And I'm joined now by senior fellow at the Brookings Institute, Klein. He's the former Deputy Assistant Secretary of Economic Policy at the U.S. Treasury Department. So, Aaron, first, your reaction to the federal actions taken this weekend to backstop customer money from banking shutdowns. Have they made the right call so far?
Well, look, I was hoping that this morning they were going to be able to announce a purchase, that they'd sold the banking business to another bank and avoid having to bail out the uninsured deposits. And that's what they did. Secretary Yellen was spot on that they are not bailing out the equity holders or the debt holders in the bank, which happened, unfortunately, during TARP. But there is a bailout here involving the uninsured depositors, large corporations, big tech like Roku, Roblox, Circle, the big stablecoin issuer. Those folks got a pretty big bailout this morning. And that was unfortunate, in my opinion.
So expand on that a little bit, because Secretary Yellen saying that there would be no federal bailout. How would you define what she's not calling a bailout versus what you think happened for some of these companies?
So what she said is that they're not bailing out the equity or debt holders in the bank, and that is correct. What they are doing is bailing out the uninsured depositors. That are the large corporations. Like 97% of Silicon Valley Bank were uninsured deposits. So these were big companies with lots of money, often who had other relationships with venture capitalists that could have involved different aspects of Silicon Valley Bank's financial holding company. And those folks are getting bailed out. They're getting 100 cents of their uninsured deposit back. And who's going to pay that? All of us. All of us are going to pay that in the form of higher bank fees. So she's right that one group of people aren't getting bailed out, but another are.
Right.
And look, this continues. The Federal Reserve has been bailing out money market mutual funds and even junk bond holders under the auspices of COVID relief. So there's been a long pattern here of bailouts for big wealthy corporations and very wealthy investors.
Well, I don't want to put words in your mouth, but it seems like you don't think that this is a good precedent to set. What other option did the Fed have to try and prevent a mass problem here in the economic sector?
So the first thing the Federal Reserve could have done is supervise this bank. The Fed regulated Silicon Valley Bank from head to toe. Look, in the 2008 financial crisis with these giant banks with tons of different regulators and lots of different tentacles, the regulators all did this to each other about who was in charge. And part of what Dodd-Frank did was really put the Fed in charge. And ironically, Silicon Valley Bank was head to toe regulated by the Fed. And what in the world was the Fed doing as the supervisor and regulator of this entity over the past few years when it quadrupled in size, right? Classic red flag. Relied heavily on uninsured deposits, 97% hot money uninsured deposits who could leave far more easily. This isn't like a regular bank. And then bet heavy in interest rate, in mortgages, that they didn't hedge their interest rate risk. I'm kind of running out of red flags to put up as a warning sign. And the Federal Reserve seemed to keep giving this bank a clean bill of health. So that's the first thing they could have done differently. The second thing
Can I just follow up on that, though? So was the issue here that the regulations were too lax, or that the Fed didn't do a good enough job of enforcing those regulations?
So the first issue is the Fed didn't do enough good job. There's in banking, there are these two terms, regulation and supervision, and they're often used interchangeably, but they're different concepts. Regulation are the rules. Supervision is the application of those rules. The Federal Reserve in Washington, D.C. writes the regs. The Federal Reserve in San Francisco supervises the institution. And right now, fingers should be pointed at both of those entities because, number one, the supervision was clearly deeply lacking. And number two, the regulation had some issues, too. In part of this regulatory rollback that you were just describing, where some numbers got changed about what banks were subject to what, particularly raising the threshold from $50 to $250 billion. What you saw there was the Fed said, oh, no, but we're going to maintain in this system the authority to do things for banks less than 250. Just trust us. If we see a problem, if we see a systemic institution, we're on it. Now, today, we're waking up being told, oh, oops, not only were we not on it, but this entity we didn't think was systemic, so we didn't pay that type of attention. Turns out it is. Oops. Sorry, America.
Yeah. So as a result, does that mean we need reforms to the regulatory system? Is this just an issue of trying to reform the way these regulations are enforced? How do we prevent this from happening again?
Right. So look, there are a couple of things. Number one, we absolutely need to hold the people accountable here, both at the bank. It was a huge failure of management and a huge failure of supervision throughout the Federal Reserve System. So people have to be held accountable. I think some of the rules have to change. The other problem is you write rules predicated on the quality of the judgment of the people who enforce them. And when the people who enforce them keep getting it wrong, maybe you need a very different set of rules. More broadly speaking, I'm very concerned about the constant precedence of bailouts. One of the things that's possibly making the system less safe today is money is being moved by corporations out of banks and into money market mutual funds. Why money market mutual funds? Well, the Federal Reserve has bailed them out in 2008 and again in 2020 under COVID. While money market mutual funds were designed not to be insured by taxpayers, repeated bailouts by the Fed every time one of them has broken the buck have created an assumption among people that it's as safe as a bank deposit.
Right.
And so you have greater contagion and the potential for more money. So this culture of bailouts to prevent a little bit of pain today, or maybe a lot of pain today, we continue to hollow out and make ourselves less safe for the future.
Okay. Aaron Klein, you gave us a lot of really good information there, sir. We appreciate it. Thank you for being with us.
Thanks for watching our YouTube channel. Follow today's top stories and breaking news by downloading the NBC News app.